In the meantime, regulators are going to unveil new rules for small and mid-sized banks with more than $100 billion in assets. Those moves are designed to protect borrowers in case of more bank failures, such as the sudden collapse of Silicon Valley Bank that we saw in March. Our banking reporters, Huson and Leslie Picker, are covering the story, reporting, and regional banks face another hit as regulators force them to raise debt levels. Hugh and Leslie join us now. It's good to see both of you. Leslie, let's start with you. What are the new requirements for these banks?
Basically, what regulators are doing is they're taking this group of banks that's between $100 billion and, say, $700 billion in assets. So the ones that fall beneath those that are deemed systemically important, and they're basically kind of enacting some of the same requirements and rules that the largest banks have already had to comply with. One of those is this long-term debt requirement, which essentially acts as a buffer in case of failure. If a bank, as we saw in kind of March, April timeframe, if a bank fails, having a long-term debt component can effectively serve as kind of a buffer between the bank failing and needing to be costly for depositors, both insured and uninsured. So that's kind of the thinking there. They're also redoing some of the requirements for living wills, essentially a wind down plan for a bank in the event of failure. All of this, banking lobbyists are saying, could be more costly to their bottom lines.
Okay, so Hugh, when you're looking at this, one, how does the debt provide this buffer? And then what's the long-term impact?
Yeah, so the debt is, just think of it as a pile of money that's there. It's long-term debt, so it should really represent the increasing or decreasing risk that a bank needs to be rescued and saved by the government. And if it's there, it essentially will be a buffer against losses. That buffer protecting essentially the public. When you think about the public, we're talking about uninsured depositors who are, who have their money at a given bank, and ultimately the FDIC, which has got their insurance fund. And so what we've seen here, and Morgan Stanley has written a note about this yesterday, is this will impact and feed into the pressures that the regional bank industry faces. They're already under the gun in terms of profits because of rising interest rates and competition. Five banks in particular. So they named 5 specific banks: Regions, Fifth Third, and a few others.
M&T Bank, Citizens Financial, and Northern Trust.
And Citizens Financial. And their analysis was that they're already below this requirement for long-term debt. They're going to have to issue debt, which, by the way, should be more expensive given some of the downgrades to the banking industry in general in terms of their credit ratings. And they've got to issue debt into a not friendly market, so they'll have this pile of money in case they fail.
So, Leslie, let me ask you, this feels to me like the government requiring the banks to have effectively a line of credit in case they run into trouble. This would be debt that they would issue at whatever the market rate is. And that debt does what? It just sits there on their balance sheet. It can't be used for anything but this kind of protection. It can't be used, as long-term debt often is, for capital expenses to expand branches or improve technology or whatever. It just has to sit there as a resting pile of dough in case the in case the bank runs into trouble.
Yeah, I kind of wish I had a resting pile of dough these days. No, you're right, Tyler. It's there almost like a kind of a rainy day fund. Think of it like that. And kind of speaking to the overall issuance aspect of this, Ben Emons has a note out saying that an increase in long-term bank issuance can actually drive higher long-term yields in treasuries. So this could have some of this self-fulfilling prophecy whereby, as Hugh pointed out, you're issuing debt in a not such a friendly market necessarily, given where rates are, to issue debt. It could be increasingly costly depending on the directionality of rates as this is implemented potentially over the next few years or so. But then, broadly speaking, it could, given just the size of this market, have an impact on, where yields are just in the broader scheme of things. Well,
and given where interest rates are right now, is there any chance this actually puts more strain on these banks? What do you think, Hugh?
Well, I think it's pretty clear. And, the regulators were forthright with this. They said that this would add to their funding pressures or add to their funding costs. So, along with all the other things that we know are afflicting regional banks, this adds incrementally to that pressure, which, will develop over the next few quarters. And for what it's worth, feeds into this narrative that the end game for regional banks has to be more consolidation, right? If you have rates that are higher for longer and these regulatory pressures, that the only way out of this is that they consolidate. There are 4,600 banks in this country. Will there be that many in a few years from now?
Leslie, thank you very much. Appreciate it.